Yeah, good morning, Carl. Great to see you.
We spent part of the last half hour talking about a lot of the cost-saving efforts that smaller firms have been undergoing in the wake of all of this uncertainty. But I wonder, are we entering a period where innovation getting funded is going to be a much tougher slog?
Yeah, it's a great question. I think, to contrast what 22 is like compared to 21, right? 21, the companies were in the driver's seat. They were raising lots of money. They were competent. They were hiring at a very rapid clip. And fast forward to today, that's changed. But that being said, there's still a lot of money flowing in, right? So venture capital is down from an all-time high last year, 30 to 40% down, but it's still going to be the second strongest year in history from a venture capital deployment. Plus, number one is that venture capitalists are raising a lot of money. So there's a lot of dry powder. But in front of us, as you said, there's going to be some layoffs. There's going to be lower spending, all those things. But it actually makes sense and hopefully will end up being a much healthier market at the end of the day.
Yeah, I was going to say, you sort of see it as a healthy cycle that's going to reimpose some discipline. Were you seeing signs at the peak of real lack of discipline? Were companies spending like sailors?
So discipline it's an interesting question, right? So when you raise a lot of money and your investors want you to spend that money, right? That's the whole point of it. They want you to invest in the business. They want you to hire more people. They want you to spend on advertising, right? So I would actually argue that companies were doing what they were supposed to be doing from their investor perspective, right? That has changed, right? Now those investors are pulling back and saying, slow the spend, slow the hiring, slow the advertising, all those things. And again, that shouldn't be surprising to us. Now, what's important to note is that companies are so much better off than they were during last cycles, right? So if you look at companies that are in that $5 to $15 million revenue range, right? If you go back and look at the last cycle, there is roughly 30 to 40% more cash on their balance sheet. So they can weather a lot more storms than they could historically. So there's a lot of positive things despite the headwinds that they have in front of them.
Yeah, and Greg, to your point earlier about dry powder, there's also a lot more of it than there were in previous cycles, which could benefit you guys. I wonder if you could tell our audience a little bit about your credit risk, because you guys do operate at the heart of Silicon Valley, and as we see startups execute layoffs and cut their spending, you guys are actually relatively underexposed. So it's just 2% of SVB's total loans are now to early stage companies, right?
Yeah, I'll start to kind of reinforce what I said a minute ago, which is companies are better positioned than they ever have been to weather a storm. Number one. Number two, they've already been through recently, right? 2 years ago when the pandemic started, they were all cut costs, save money, lower your burn. So they've already been through this recently. It's not as if it was a decade ago when that happened, right? So that's a positive side. Now, for us, you're right. Most of our loans are to mid and later stage companies, venture capital firms, private equity firms. So those companies are doing well and financially incredibly strong. That early stage side, when they have less money, it is higher risk. But to your point, it's a smaller percentage of our overall portfolio. Last quarter, we took a higher reserve just to kind of, as we looked out in the future, we wanted to be prepared for if more challenging times were ahead of us. So we're feeling good about the situation and the position we're in right now. And our balance sheet, capital ratios, liquidity has never been stronger. So we're looking at this as an opportunity to partner with our clients, to support them. We've never seen the amount of requests for new debt. And so we're feeling good about the growth in lending over the balance of the year for tech and life science companies.
Well, when you look at those requests for debt, how are you measuring health, perhaps differently now than you might have in previous quarters? The health of these companies, top line growth aside, what are the main sort of vital signs you're looking at to determine who's doing better than others?
Yeah, well, obviously it's the revenue growth. It is how sticky that revenue is, right? We're a couple quarters into this correction, recalibration, and so how much has changed? And if companies are still doing well, and many companies are still doing well, that's obviously a great sign. How much cash, how much liquidity they have, what support they have from those investors is another category, right? So all those things come into our analysis to determine which ones we should be leaning into and which ones we should be kind of, I'll call it wait and see, to see how they play out over the next few quarters. Again, we've been doing this for 30 plus years, and so we've been through many cycles, and I think we feel really good about our process and understanding of how to approach working with companies, especially through difficult times. So in some ways, it's a better market because last year we were competing with equity. Now that's more challenging, and so we're getting a lot more requests and we're getting a lot more attention, which is a good place to be.
Oh, that's interesting. Yeah. Well, huge implications for the kinds of things we cover here, Greg. We're very grateful. Good to see you. Thanks so much.
Absolutely. Take care.